So classification of accounts under American system of accounting. Under American system of accounting, the classification of accounts, assets account, expenses and losses account, expenses and losses account, capital account, liabilities account, incomes and gains account. So under American system, American is also called as a modern system of accounting. Under modern system of accounting, the accounts are maintained of 5 accounts and the rules here. So rules here is debit and credit rules. Now first we should know the classification of accounts here. That is asset account, expenses and losses accounts, capital, liabilities, incomes and gains account. So this topic already I discussed. The assets. So assets are all the assets, tangible assets, intangible assets, current assets, all assets comes under the asset account. For example, machinery, land and building, equipment, tools, cash, goodwill, patents. So all the assets comes under the asset account. Tangible, intangible, fixed assets, current assets, all assets comes under the asset account. Next, expenses and losses account. The expenses incurred by the business while operating the activities of the business. So those expenses and losses comes under the expenses and losses account. Example, salaries, rent, wages, commission, interest. So all expenses comes under the expenses and losses account. Now the rules here, debit and credit rules. Assets, expenses and losses, if it is increases, should be recorded the debit side. Next, expenses and losses, if it is decreased, we have to record the credit side. So this is the assets, expenses and losses. Increases debit side, decreases the credit side. Increases debit side, decreases the credit side. Now, capital, liabilities, incomes and gains. So capital, the money or monies introduced by the owner to start the business is called as a capital. So capital may be in the form of cash or may be in the form of goods. Next, the liabilities. So liabilities means what owners has to pay, what business has to pay to the others. That is liability. Example, loan, bank overdraft, outstanding expenses, creditors, so bills payable. So all the liabilities, short-term liabilities and long-term liabilities. So incomes and gains. Incomes and gains means revenue. So what revenue earned by business, those revenues, incomes we have to record here. So example, commission received, interest received, dividend received, interest on investment. So all we have to record here. So rules are capital, liabilities, incomes. If decreases, if it is decreases, we have to record the debit side, and if it is increases, in case of increases, we have to record the credit side. So it's an opposite to assets and expenses, debit and credit here. Now, so this we can say debit and credit rules under American system of accounting and modern system of accounting. Now, with the help of transactions, let us will find out debit and credit. So transactions, there are two types of transaction: cash transaction and credit transaction. First, purchase the machinery for cash. First, we have to analyze the transaction. Then we have to find out that in each transaction, how many accounts are involved. See, purchase the machinery. Purchase the machinery for cash. So, in this transaction, so two accounts are involved. Machinery account and cash account. So, business, the owner is purchasing the machinery here. So, two accounts are involved. Machinery and cash. So, machinery. So, machinery and cash. So, in this transaction, two accounts are involved. Purchase the machinery for cash. So, machinery account and cash account. So, machinery is an asset. Cash, machinery is an fixed asset. Cash is an current asset. So both machinery and cash comes under asset account. Comes under asset account. Now you apply the rules. If assets increase, should be recorded debit side. So purchase the machinery. So machinery is coming to the business. So machinery is an asset. Assets is increasing here. So assets is an increasing. So it should be debit side. Machinery account debit. Now cash comes under assets account. So assets rules. If decreases, if assets decreases, we have to record the credit side. So purchase the machinery. So machinery is coming to the business. So assets is increasing. So machinery we have debited. We have paid the cash. So cash is an assets. So assets cash is decreasing. So as per the rules, we have taken credit side. Now one more example. Paid salaries rupees 3,000. So in this transaction, two accounts are involved. So paid means cashier and salary. So two accounts are involved. First, salary, and next cash. Paid salaries. Salaries and cash. So salaries is an expenses. Paid salaries, rent, wages, interest, commission is an expenses. So expenses rules. Expenses rules. Debit increases. If expenses of your paying, it is an increasing. Increase in the expenses should be debited. So you are paying expenses. So expenses here increasing. So it should be debited. Now cash, you are paying cash. So cash comes under asset account. So asset account rules. Asset account rules. Cash, if it is decreases. If it is a decreases, we have to record the credit side. So this is credit side. Did you got? Paid salaries rupees 3,000. So in this transaction, two accounts are involved: salaries and cash. Salaries and cash. So salaries comes under expenses and losses. Expenses and losses rules. If expenses and losses increases, we have to record debit side. So expenses, you are paying expenses here. So expenses is increasing. So salaries we have debited. Next, cash is an asset. So rules are, if assets decreases, we have to record the credit side. Now, while applying the American system, the debit and credit, if you get any confusion to find out debit and credit, once again you go through the English system of accounting. Through the English system of accounting also we can classify and we can find out the debit and credit. Next, so took a loan from bank. So business is taking a loan from bank. Loan from a bank. So in this transaction, two accounts are involved. First cash and next loan. So here we are taking loan from a bank. So took the loan from a bank. So two accounts are involved. So took loan means we are taking cash from bank. So cash is comes under the asset account. So this is asset account. So here asset. Next bank, there is loan here. So loan, taking loan from bank. So loan is comes under a liability. So cash is an asset. So assets rules. If assets increases debit side, you are taking loan from bank, it means you are getting cash. So cash is coming to the business. So cash is increasing. That is assets is increasing here. So assets increases should be recorded debit side. Next bank loan. So loan is a liability. Loan is a liability. So liabilities rules, if decreases, when it is decreased, if you repay the liabilities, that time liabilities will decrease. But in this transaction, we are taking loan from bank, so that is liabilities is increasing. So loan is comes under liability. So liability, if it is increases, we have to record the credit side. So this is credit side. Cash is an asset, debit side. Bank loan is a liability, credit side. So here assets is increasing and liabilities also increasing. So assets increases debited, liabilities increases credit side. Now, so this took loan from bank. With the help of American, we have found out debit and credit. With the help of English system of accounting also, we can find out. Example, took loan from bank. So in this transaction, two accounts are involved, cash and bank. Cash is comes under the real account. So real account rules debit what comes in. So we have taken debit side. So bank is comes under personal account. Debit the receiver, credit the giver. So bank is the giver. So we have taken credit side. Next transaction, received a commission for rupees 1,000. Received commission means we are taking the commission in the form of cash. And next commission received. So in this transaction, two accounts are involved. One is a cash account and one more is a commission received account. So cash is an asset. Cash is an asset. So assets rules. If assets increases, debited. So cash is increasing here. Received commission. So cash is increasing. So this is the debit side. So commission received is an income. So this comes under the incomes and the gains. So incomes and gains rules. Incomes and gains, if it is decreases, should be recorded debit side. If it is increases, should be recorded the credit side. Received commission, received interest, received dividend. So all it is under income. So if it is income increases, we have to record the credit side. So this is credit side. Next, paid interest. Paid is you are paying cash here. So two accounts are involved. Next, interest. So in this transaction, two accounts are involved. Paid interest, cash and interest account. So cash is an asset. Interest is comes under the expenses. Paid interest, we are not receiving interest. Paid interest is an expenses. So cash is an asset. Paid interest. So cash is decreasing here. Cash is decreasing. So if assets decreases, if cash decreases, we have to record the credit side. And interest, paid interest. So interest is comes under expenses. Paid, we are paying interest. Expenses, so expenses rule. If it is increases, debited. Paid interest, commission, rent, wages, salaries. It shows that expenses increases. So increases it will be recorded the debit side. So this is a simple way under American system of accounting. Under American system, the accounts are classified. So 5 types of accounts. So and there are debit and credit rules. So dear students, watch this video, comment, share and subscribe. Thank you.